In this video, I just wanted to look at, just with the talk of interest rates moving up, which they have from the Fed, and just kind of the impacts of what that could, lead to, I guess, within the commercial real estate market. Really just kind of pulled together some of, just some calculations in an Excel sheet, more or less just looking at cap rates. In this case, I just assumed a hypothetical $100,000 yearly net operating income, and then the cap rate, which would then compute to the valuation of what the building would sell for, and almost looking to just see what is any trends or any things that can just be taken away from this. More or less, the one thing that I started looking at is just the change in value of as we're coming off of this historical low interest rate environment, kind of I guess coming back, trending back towards what would almost be considered normal. Of higher interest rates, or a higher rate than we've had for probably the last at least 5 years or so. But one of the things that really stuck out was just the change in value of keeping at essentially a 50 basis point increase between these cap rates, and just looking at these really low rates, leading to huge changes in value, which you might be like, hey, nothing sold for a 2.5 cap or a 3 cap, depending on what coast you're at. I mean, things do occur of that in Los Angeles. Not so much in Ohio like a lot of my other videos. However, it is just stuff to be aware of as we've kind of coming off this historical, low cap rate, low interest rate environment where, let's say, we've trended to see stuff kind of in this range. Maybe we see stuff, in this range, for the next 10 years or so, and just kind of what does that look like? It's kind of interesting in the sense of the change in valuations at these low cap rates. Obviously, since the division of it leads to almost a exponentially larger amount, just because of the number. But it's just kind of interesting to almost see that the way that these numbers have changed. Of looking at this graph I just kind of threw in there, you can see the slope in the line is almost exponential, and then as you get down to these other cap rates, it's really not as big of a difference. Just kind of interesting. Just kind of almost show that there's a hidden leverage in pricing, just due to the capital stack of what prices are getting paid. And I guess it's not really the capital stack, but just what the implied value is. It's at some of these different levels. So as we just go forward, if the Fed raises rates tomorrow or not, at some point, the yield curve will probably normalize, and at that point we'll probably then have better stability in pricing. Until then, we'll just continue kind of meandering along. But this is something I just wanted to point out. Seems kind of interesting looking at this data of just what the changing valuations would be for different cap rates. It looks like at this higher end, the significant changes. I mean, for example, if you bought like a Starbucks at a 4.5 cap, and then it's worth now 5 cap, essentially you've eroded almost half your equity value if you bought it with 70% leverage, or so 30% down payment. So essentially like 1/3 of your equity value is just evaporated essentially. That's a conversation to look into loan covenants and things that might have to true up. You might be in a technical default just depending on the way that it is structured. Just as it's one thing to look at is you just look further down this capital or the cap rate assumptions on this. Is just the change in values really don't. It's almost not as like hiddenly leveraged in it. So just kind of bring that to your attention. And then if we look at kind of in the same vein here of just looking at what loans will do, it's kind of interesting to see what the interest payment is this is just assuming a 25-year amortization outstanding loan of $1 million, and then just calculating essentially what those loan constants are. And one of the things that, to me, that was really interesting was the interest to loan constant. There's a significant variation between them. So if your interest rate's at 3%, your loan constant's at 5%, and just as you increase rates, let's say 7, 8, even 9%, the change from the interest to the loan constant is it goes down significantly. I mean, you can see it's the loan constant's essentially almost 90% higher than the interest rate. Whereas if you look, down this capital, just down the assumptions to 10% rate interest, it's only about 10% higher. Just I guess as you're doing back the napkin math, what does this stuff mean for capital structures? Definitely for underwriting stuff in your head before you even hit the back of the napkin thing. It's kind of interesting just to have those assumptions, brought forth. But as we've kind of creeping up here, essentially it looks like at the point of which leverage is accretive, will end up being closer to what the actual interest rate payment is, or interest cost is on your loan, just to say it that way. But more or less, just wanted to bring this to your attention. I think it's something interesting to look at. It's just as we have these kind of huge tectonic plates that are shifting within the real estate market, and what those impacts are. It's definitely good just kind of look at the forest through the trees, and not necessarily on in any individual deal, but to look at what the total landscape is and how it's shifting. So hopefully that can bring some insights of just kind of looking at this stuff in a different light, of not necessarily in the trenches on specific deals. Hopefully that helps.